In this video, I'm going to show you everything you need to know, start to finish, on how you can make money passively, safely, and consistently $5,000 or even $10,000 a month using Leap options, and in this video specifically on SoFi. And I'm going to show you how to use it on your favorite stock as well. I'm going to show you my strategies, how to hedge if the stock goes down, and everything you need to know to make money. So sit tight and be ready to learn. Let's get started. However, before we get into today's video, huge announcement. For the first time ever, I am hosting my masterclass webinar this Friday, April 25th, 6 p.m. Eastern Time, 3 p.m. Pacific, on volatility and hedging in a bear market and how to make money in these conditions using analytics as well as understanding the sentiment. It's the first time I've ever done this. You're going to learn things that I've only taught exclusively to my elite students and Discord students. You're going to learn some of these strategies this Friday. Links in the information box below. Very limited spots for this webinar. First time ever. Huge announcement during the webinar. I'll have a Q&A. I look forward to seeing you there. So the very first thing we want to do is figure out where the bottom is and the top on your favorite stock like SoFi. We also want to evaluate this stock to see if it's really worth the investment. And once we figure out if it's worth it, and we find a bottom, and we find a top, we start looking to pick a spot to enter to buy these Leap options. Typically, I recommend 1 year. It's a little bit cheaper, but you can go out 2 years, and it's more like holding the shares because it's such a long duration of time that it's very similar to holding shares. Now, you can also dollar cost average your Leap options, which I am going to show you how to do. When you have Leap options, it's very similar to shares because each option, you're controlling 100 shares. And if the stock goes down and this Leap option becomes cheaper and you buy another Leap option with the same strike price and the same expiration, it will give you an average cost between the two. So if you own 5 $10 Leap options on SoFi, and those 5 $10 Leap options cost you $500, that's $2,500. If you buy another 5 $10 Leap options, but they cost you $300, that's $1,500. So now the difference between $1,500 and $2,500 is $2,000. So you now have 10 Leap options at $2,000. So this gives you an average cost similar to shares pretty much. So what we want to do, we want to find an average price where SoFi typically sits. And we can see there is a lot of time that SoFi spent in between $6 and $8.50 or $6 and $9, this $3 range. But after this big gap up right here and right here, the stock ran all the way to $18.30, came back down, and it touched and filled this gap all the way into the recent highs on SoFi, which was $8.50, $8.75, and $9, and now it's coming back up. So we can see right here at the different averages that I have, the black is the 100-day, the pink is the 50-day, the purple is the 200-day, and the orange is the 10-day. The light blue is the 20-day. 10 below the 20, they both have crossed over the 200-day right here. And this is usually a death cross, which is what they say. And then, of course, you're also looking at the 50-day crossing below the 100-day. Now, when we go on the 4-hour chart, we can see that the 10 is crossed above the 20. They both crossed above the 50. And we can see the stock is crossed above the 100. Now, what we're really looking for long term is we would like to see a change of character, which actually has already happened. A change of character was right here, and right here was a break of structure. It would ultimately be nice to break 1270, but I don't think that's going to happen just yet. It's possible, but everything so far is looking good for a reversal. A great time to get in was when I bought shares last week, which was $11 flat, $10.80, $11, $11.20, in that range. That is the complete change of character, and it happened again right there at the 1160 mark. Now, SoFi overnight is up even higher. We're probably going to end up somewhere in the 1250 range if everything keeps going the way it's going, which is good. So we can see that the stock is turned around. What we need to figure out is where the bottom really is on this stock. And true truly the bottom is in the $8 range and $9 range right here. $8.50 to $9 is truly the bottom. So $11 to $12 is a little bit up there. But you have to go into this with the mindset of, hey, I'm going to buy Leap options now, but if the stock drops back down to $10 or $9.50, I am going to dollar cost average these so that I have a lower cost basis for these Leap options. So when the stock does run again, I make back my losses quicker and make more money. I'm going to show you exactly how to do that. Now that we've figured out a good spot to enter on the stock is between $8 and $10, and we're just a little bit above that, we have to pick a strike price on this Leap option and figure out exactly what we're looking to do. So now we've done all the technicals. We also want to make sure the stock is good. Price to earnings is 27. Anywhere between 25 and 30 is good. 15 to 25 is really good. And 10 to 20 is stellar, depending on the range that it's at. This is really good for SoFi. And considering this is a growth stock, this is really, really strong. 27 is a great PE ratio, but you want to look at market capitalization, which is 12.44, and you want to divide this by the trailing 12 month, which is under financials. 3.77 goes into 12.44, and this is going to give you your price to sales. I'm going to show you how to calculate this. So we're going to do 12.44 and divided by 3.77. This gives you a 3.29 price to sales, which is stellar. Apple's is a 10 or 11. Tesla's like over 20. Microsoft is even higher than Apple's. When you look at that, anything under 10 is growth. Under 5 is extreme growth. And SoFi was at 2.1 and 1.9 last year. And when it hit $16, $17, and $18 very recently, the price to sales went up to 6. And now it's back down to 3.2 based on this data. So when you look at this data, it gives you a gauge of how much potential the stock has to potentially grow into its evaluation. When you're looking at stocks like this, you have to set forth an expectation of price to sales. And typically in the financial sector, they range between 10 and 15. Sometimes a little higher, sometimes a little lower, but 10 to 15 seems to be the going average. In a lot of tech stocks, it's between 8 and 12, but I pretty much give most stocks an average of 10, just as a standard generalization, but that's roughly where they are. When you look at SoFi being 3, essentially there's a 3x return on the table, meaning SoFi could very realistically be $30 to $40 in the next year or 2, or maybe 3 years, depending on how things go. And remember, Anthony Noto said it's not a matter of if, but a matter of when they become one of the biggest banks in the United States. And so he's a great CEO, sandbags the stock a little bit, under promises, over delivers, which is good. When we look at the financials, trailing 12 month is good, total revenue is good, pre-tax income is good, net income is also good, EBITDA is great. This is very important. All of this is good. So looking at net debt, anytime you have a negative net debt, it means you have no debt. Anytime there's a negative net, it means it doesn't exist. $1.62 billion in cash they had in Q1 24, but now they're up to $531 million in debt, but their total assets cover liabilities and their debts, so they still have a lot to cover, which is good. Look at cash flow, $1.27 billion in cash for operation activities trailing 12 month and $1.21 billion in just one quarter alone. There's a lot of growth here. The most important thing is the free cash flow, $1.1 billion, and pretty much all of that coming in the most recent quarter. A lot of exponential growth here. Free cash flow is very, very important, and they have that as well. So strong stock, strong fundamentals. We've got to change a character, break a structure. Let's pick our Leap options and see how we can generate safe passive income from these Leap options. So what we're going to do is we're going to go out 2 years, I prefer, so you have more time, but you can do it 1 year and it's cheaper. If we go to January 2027, it's just under 2 years. We'd be looking for an 85 delta, which is a $7, or a 74 delta, which is the 10. I would buy the 10. Now, what we would want to do is understand exactly what we're doing and why we're doing it, which 74 delta means you're essentially with this contract controlling 74 shares, because that's what the delta stands for. 74 delta means every time the stock goes up, the option goes up by 74. So the stock goes up $1, the option goes up 74 cents, which is the equivalent of 74 shares. Now, you also have to add gamma 0.0314 every time it goes up $1. So essentially, if it goes up $5, the delta is going to be closer to 90 or 95. If we go to 5, the delta is 91. You see, $5 difference is 91. That's because of the gamma adding to the delta. So if you buy the sleep option at $10 going out to January of 27, you'll see it is $4.70. You have to add that. So 4 1470 would be your average cost, which means if you sell covered calls below 1470, well, then you would be essentially losing money if you got assigned. If the stock goes above 14 or 13, wherever you're selling a covered call, then you essentially would have to buy that call back at a loss and then sell your leap at a gain because they move in tandem, and you'd break even, maybe make a small amount of money. But typically you want to be selling covered calls that are equal to your cost basis. So I want you guys to understand what happens when the stock goes up. So if the stock was to go up $5 to $17 in the next year, well, then your option would be worth a lot more. So we look at the $10 option that you're buying. Going up $5 would essentially mean that this option would be worth very similarly what the $5 option is worth, which is $740. So if the stock goes up $5, then the option, your $10 option, is going to go up about $2.50 to $3. So you're going to make decent money. So we can sit here and figure out that if you bought 10 leap options for $470, then you're going to make about $3,000 on these 10 leap options. So you're essentially putting up $4,700 to make $3,000. So it's realistically, this is like a 50% return, 40% return, depending on where the stock goes. And we've seen SoFi goes up quite a bit. So it's going to depend on how many options you have. Now, what I want to show you is if you were to buy leap options going out 1 year, it would obviously be a decent amount cheaper, and you would be able to have a little bit lower of a cost. So if we go with a $10 option, it's $370 for the year, which means 10 plus $370 is $1370. You could really start selling $1350 or 14 calls, which is only $2 out of the money. So let's do this. Let's go out 30 days and sell covered calls at $1350, even 14. If we were to sell 50 call contracts, then in 1 month, we would make about $1,300. So what we're going to do here is we are going to buy 200 leap options. Now, this might seem like it's crazy because it's a lot. 200 leap options is quite a bit, but they're cheap. They're only $300. So essentially, it is cheaper than buying 200 shares of Meta. It's very cheap, at least by comparison, because you're controlling essentially 20,000 shares are being controlled. And we're going a year out, 12 months. So you have time. SoFi's fairly at a bottom. So I'm going to show you what we're going to do. We will start selling 1350s going a month out. 200 contracts will get filled maybe at 36, maybe more if the stock goes up a bit. So $7,200 a month. This will generate $7,200 a month. If this was to happen and the stock was to go above 1350, well, then we could roll out a couple of weeks and up to 14, or we can just buy back the short call at a loss and sell the leap at a gain because they move in tandem. So if the stock was to go to, say, 14, well, then you'd have 200 contracts worth 50 cents, which would be, because it's 50 cents in the money, which is 10,000. But you would have 200 contracts that went up $4 or $5, which essentially is going to be $2.50 to $3 increase in price. So 200 times $300, you made $60,000 on leap options. So you'd end up buying your short calls back if the stock was to go to 14 for a $10,000 loss, but then you'd make $60,000 on the leaps. So you would literally be making $50,000. This is how it works. If the stock was to go to 16, well, $250 on the short calls, you'd lose $50,000. You have to buy them back for $50,000. However, when we look at the leap option itself, this is what a lot of people don't talk about. Sure, you're losing money on the short, but you're gaining a lot on the leap. Like, let me show you. So you bought the $10 call. If SoFi was to go like up to $16, then you're $2.50 in loss, which is $50,000 over 200 contracts. But if it was to go up to that price, $16, that's a $6 increase. And the delta being 71, if we go to the $5, the delta is 93. So between $5, it's almost $700 versus $370. So if it goes up $6, it's going to be a little bit more. So essentially, we are making about $350 per option. So if we do 200 contracts times $350, it's a $70,000 gain minus $50,000 on the calls. You're still making $20,000. Even if the stock goes $3 or $2.50 above your strike. So you can see that the more it goes in the money, the less profit you make. But for you to completely lose all of your profits, it would have to be really deep in the money. The stock would have to be $20 in the month that you're selling that option. And they move in tandem though. So it's going to be equal. You're still going to take massive profits on the leap options. Again, if the stock was to go to $20, well, that would be $10 away. So essentially, we would do $10 times 71. And then what we would do is times 100, 710. Plus, of course, you'd be looking at a little bit of a difference due to volatility, but it'd be a little bit higher than that actually. But we'll just say 710. That's a very conservative number. And if we times that by 200, it's $142,000. Now, 650 times 200, it's 130. So again, you're still making $12,000. In order for you to actually get to a point where they would break even, pretty much, you would be $10 to $15, $10 to $12 in the money. The chance of SoFi going from 10 to 22 in 1 month is extremely low. But even in that situation, you'd break even. So it's a very strong strategy to run this way because we found a bottom at SoFi, a fairly decent bottom. We're only about $2 away from the bottom, but we're like $6 to $8 from the most recent high. So much better buying opportunity here than selling. And that's why this is strong. So we buy these leap options going 1 year out, and every month we are going to sell covered calls, and we are essentially looking for a delta of 25 or 20. Even with $26 in these call options, you probably get 27. We're making $5,400 a month. And if we add the $370 we paid for the leaps to the $10 strike of this option, average cost is $13.70, but we're selling 14. So we could actually get assigned here and make money. If we were to get assigned, we would sell the stock at 14, and then we would use that money to basically exercise the long call at $10. So this is what would happen in that scenario. We would collect $1,400 per 100 shares minus 1,000 to exercise the leap. We're left with 400 minus 370. We profited 30 every 100 shares, and 30 times 200 means we make $6,000 even on a forced assignment. And this is extremely powerful. We also have to take into account we get to keep the $5,400. So if you buy these leap options, $10 strike going a year out, $370, and immediately sell a $14 call a month out for $5,400, and you get assigned the very first time you do it, in 1 month you made $11,400, which essentially is about a 16% return your first month, like 15% your first month. Very strong. And if you do this again for a second month, well, then you've now turned almost $17,000 profit, which is getting closer to a 22% return roughly. Actually, I think it's a little bit more. 7,000 would be 10%. So yeah, it's about 22% over 2 months, 22, 23%. You do this for a year and you're essentially doubling your money every year. But realistically, this gets me about 50% per year. This is $5,000 per month. It's a very powerful strategy. And I want to show you very quickly what I would do if the stock was to start going down. So if we entered this leap option, the stock starts going down to $8 or $7.50. What we would immediately do is when we see this starting to happen, we would start selling $13 call options, because as the stock starts dropping, we might lose that $1 extra or 70 cents, and that'll be offset by going out a month. So let's say the stock was to go to $9, it's dropped to $1.50, almost $2. And so we've lost $1.40 in every leap option. Well, we're going to make back 47 by selling the 13 call. So 1 month would cover a third of our losses. So we have to do this for 3 months to make back that loss. But typically stocks like this is why we buy them on the bottom. Essentially, you can also dollar cost average. So for example, you buy this leap option going out to March of 26, like I showed you, $10 for 370. Let's say the stock drops $2. If the stock was to drop $2, then the price of this $10 option would be similar to the 13. You'd get it for about $270. So if you buy 200 contracts like we talked about, 200 times 370, that's $74,000. If you end up buying another, let's say 100 contracts at $220, that's $96,000, and you're going to divide this by 300, giving you an average cost of $320 instead of $370. So this essentially is giving you a $1.50 break on the stock. So lowering your average cost. So instead of your average cost being when you buy it, let's say at $12, your average cost now is about $11.30 or $11.20 because now the stock has to move less. So an average cost at $3.20, we look at $10 at $3.70, 13 is $2.40, somewhere in between is $3.20. So our average cost now is about half the distance. So the stock drops $2, we need about $1 or $1.20 to break even instead of $2. It actually lowers your average cost. If you want to see a video outlining this entire strategy on how to chase your losses, in the comments below, and I'll make a video dedicated to that. But to keep things simple for beginners, essentially you buy a 1-year out leap option at $10 strike at $3.70, and we sell $13.50 to $14 covered calls every month to make $5,000 a month. If you get assigned at 14, you're full profit. If the stock goes deeper, say 14, 15, 16, 17, does not matter. You buy those call options back immediately at a loss. And if the stock is still going up, you can also ride that on your leap options to make more back on the leaps. Or you can sell the leaps at a profit. There'll always be more profit on the leaps than there are losses on the short calls. Now, I did explain to you, you could buy the shorts back at a loss, sell the leaps at a gain, and still make really good profits. But if the stock is running and you're getting pinned really hard on the short calls, buy them back for a loss, and if the stock is still running, let it rip. When the stock reaches a ceiling or it slows down and starts selling off, sell your leaps for full profit. Essentially, let me show you what this means. So let's say SoFi goes to $16 and you have $13.50 short calls that you're selling covered calls against your leaps. That's $2.50. So essentially $250 times 200 contracts, right? That's $50,000 that you're at a loss. Well, you also have 200 contracts, and if the stock goes to 16, well, then the stock has essentially went up $5. So you're going to be making about $300 on the leaps, roughly, which is $60,000, so $10,000 profit. However, if you buy back those short calls at a $50,000 loss, and the stock keeps going from 16 and goes to 16.50 or 17 or higher, you can let it rip until there's resistance. So you're looking at the chart and you see the green candles moving up and you buy them back at a loss. Let the stock keep going. Let your leap options run. So you buy back these shorts when the stock hits 16, $250 per contract loss, 200 contracts, $50,000 loss, right? Keep riding with the leaps. If the stock goes to 19, well, then the leaps have now appreciated $9. And $9 means essentially that you're going to make about $800 per leap. So 200 times 800 means you just made $160,000 minus your $50,000 loss. So if you buy these contracts while SoFi's at $12, you sell a $13.50 call, covered call. If the stock goes to 16 or 16.50, you buy the shorts back at a loss and keep the leap options in your account because the stock keeps going up. This is the kind of profit you could make in a month or two, or less in a week or two. It just depends. So understand, if the stock's running, you buy back your shorts, let the leap keep running until there's a lot of resistance and the stock starts selling off and it looks like it's going to drop, then sell it for pure profit. Doing it this way or the other way, they move in tandem. So if you buy back the shorts at a loss and immediately sell the leap at a gain, you make small profits, not really small, but $10,000, $20,000. But if you hold the leaps after buying back the shorts at a loss and continue to let the leap run, you make exponential gains. This is very safe when you do it this way because you're getting in when the stock's already fairly close to a bottom and it's got a lot of upward potential, and then you can sell covered calls along the way. Quick tip: you could also buy these leap options and wait several months for the stock to find a new home at $12 or $13 and start selling covered calls at 16 or 17. Patience is key. Remember, the stock market is patient people taking money from impatient people. If you guys want to see more strategies like this and you want to learn how to hedge in a downward market, and if you want a dedicated video to chasing losses and hedging a position if the stock goes down on your leap options, leave a comment below and I will work on a video for you. Don't forget, guys, my masterclass webinar is this Friday. For the first time ever, I'm teaching how to hedge losses and chase your losses in a volatile market, hedge your position and make money in a bearish market, and prepare for a change of character and break a structure so when the market goes up, you're in an advantageous position to make make a lot of money. I'll be hosting a Q&A and we'll be answering your questions, and I have a huge announcement during this webinar. Very limited spots remain. If you guys want to join the webinar, the link is in the information box below. I look forward to seeing you guys this Friday, April 25th, 6 p.m. Eastern Time, 3 p.m. Pacific, and I'll see you guys on the next video or upload. Take care of yourselves, fam.